Optimism has seemingly returned to our survey respondents, which has been generally absent for recent years. While we could tie much of this shift to prospective and already initiated rate cuts, it will likely take more than one rate cut to make a noticeable difference in the marketplace sentiment that could lead to any real action. So we're particularly keen on any developments in prospective rate cut momentum that might jumpstart transaction activity.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. I'm pleased to be speaking today with Sally Ann Flood, Vice Chair and U.S. Real Estate Leader at Deloitte. Sally Ann is here to highlight some of the findings from the recently released Deloitte 2025 Commercial Real Estate Outlook, which looks at ways for the industry to address challenges and maintain positive momentum in the new year. Sally Ann, welcome to the podcast.
Thank you, Sarah, for having me.
So to start off, to what degree do the findings from Deloitte's 2025 Commercial Real Estate Outlook point to next year as a potential turning point for commercial real estate?
Well, the primary indicators that will be a turning point came from responses in three areas in particular: revenue expectations, expense priorities, and real estate fundamentals. After 2 consecutive years where most survey respondents expected revenue declines, this year, 88% of global respondents now report they expect revenues to increase going forward. This, in turn, with revenue sentiment, could indicate real estate owners and investors expect better prospects ahead. With renewed optimism, then comes expectations for increased budgets. Only 7% reported further expense mitigation efforts, which is a change from 40% in last year's survey. But the big question is, if 24 is the bottom of the current commercial real estate market cycle, and it could be the case, global property valuation declines continued through the second quarter of 24, down 6.3% year over year, but the pace of decline is slowing from 7.7% 2 quarters prior. This, in combination with our survey, highlighted 68% of respondents expect conditions for CRE fundamentals to improve in 25. And this will cover areas of cost of capital, capital availability, property prices, transaction activity, leasing, rental growth, and vacancies. And this is a major boost in optimistic sentiment, anticipating improved conditions.
And what about some of the challenges that likely will persist next year?
Well, the top macro concern for global CRE firms is the elevated interest rates. And this was the resounding top choice amongst most respondents and the top concern in North America and Asia Pacific. Real estate organizations will likely face a rate environment that is just higher for longer compared to the record low rate levels from the prior decade. Changes in tax policies surged to a third position in our survey, and this is likely due to a combination of the enforcement of Pillar 2, the 15% global minimum tax, and approximately 80 countries globally are holding elections by the end of the year, the results of which may hold long-ranging implications for social and fiscal policy. In Europe, the top concern was geopolitical instability, unsurprising as we potentially enter the third year of conflict in Ukraine and further concerns across the Middle East.
And how do the findings compare globally across regions? Are you seeing similarities between the issues that are top of mind for real estate owners and investors across North America, Europe, and Asia Pacific, for example?
Well, there is a fair degree of variability across the regions, as well as by property sector, which was interesting. And this highlights for me the growing bifurcation of certain subsectors across geographies as owners and investors become more selective about their capital deployment opportunities. Regionally, respondents from North America and Asia Pacific expressed greater optimism for improved leasing and capital market conditions compared to those in Europe, and slightly above 70% for North America and Asia Pacific, compared to the mid-60s for Europe. We saw that sentiment in Europe was more reserved than the other regions, although they did expect improvements in capital market conditions compared to leasing or lending conditions.
And does the survey point to any changes in the types of asset classes that present the strongest opportunities today?
Well, I found this part quite interesting. The jump to the top of the global list was industrial and manufacturing facilities. with the digital economy properties remaining as a global powerhouse. The demand for data centers has proliferated globally with the adoption of artificial intelligence. Two other asset classes that rose in our survey were multifamily and hotel, with logistics and warehousing coming in fourth position, consistent with the prior year. And consistent with your earlier question, these top 5 asset classes that present the great opportunities over the coming 12 to 18 months varied in ranking across the global regions, with multifamily leading for North America, digital economy for Europe, and industrial and manufacturing from our Asia Pacific respondents.
And Sally-Ann, what about capital deployment by CRE owners for the rest of this year and into 2025? What is your research pointing to on that front?
Given responses to our survey and feedback from our subject matter experts at Deloitte, we have several key pieces of advice that we point to for capital deployment in 25. The first being, do not just buy the dip. Aim for next generation facilities that can be smarter and greener, or for businesses in high growth sectors. The next area was to have a long-term growth horizon. Even for property sectors that have become more embattled of late, owners and investors who have held those assets for longer timeframes have likely accumulated enough valuation growth to have been insulated from the latest declines. For example, on average, across the 20 largest metropolitan areas in the US, an office property purchased 5 years ago, like the first quarter of 2019, is still valued 15% higher than it was at the time of acquisition. The third area was to consider markets with a healthy balance of supply and demand that can offer fewer volatile swings in fundamentals. In geographies where there is limited new development opportunities due to restricted land access or high costs for ground-up construction, consider value-add or opportunistic properties in well-located areas, then redevelop these assets into more modern facilities. Don't rely on assets, property sectors, or locations that might require that V-shaped recovery. And then finally, it was to prepare for active asset management. Those who are able to actively add value to commercial assets during the whole period could position themselves for outsized returns over those who simply buy, hold, and sell.
And turning to technology, is AI still a work in progress for CRE? Where is it helping and where is more progress needed?
We do think that CRE implementation of AI is still in its infancy. 3/4 of our survey respondents are either researching or piloting or in early stage implementation of an AI-enabled solution. But there has been notable progress from responses on this from last year as firms are moving up the maturity ladder fairly quickly. Of the focus areas where respondents are targeting AI, those still in the early stages, we're looking to use it for accounting and reporting. But those further along, they're looking to use it more for FP&A, internal audit, and some are even targeting property operations. And we do believe that the benefits of AI adoption in commercial real estate are wide-ranging, and automation can help real estate decision-making processes more efficient and streamlined. For example, predictive forecasting for rent growth, the ability to analyze large volumes of data quickly are just some of the ways that AI can contribute.
Great. Does the Deloitte survey indicate if CRE is focusing on attracting and retaining the next generation of talent?
Well, based on the response patterns year over year, there does appear to be changes in hiring and rotation strategies, but some annual variability. In recent years, hybrid and flexible work options were near the top, but this fell to the bottom of the list for 25, which was very interesting. And this year, it shifted more towards DEI commitment and accelerated career growth opportunities. One action that has stuck for 2 consecutive years is to focus on reskilling and upskilling. As CRE looks to advance with technologies and operate in new innovative ways, workforces need to change and adapt to fit those shifting business needs. And CRE organizations really have to consider a shift from the legacy role-defined positions to more skill-based, or risks of coming to a potential retirement cliff.
Sally-Ann, to wrap up, can you describe the general mood this year's survey conveys and what you are most likely to be watching for CRE in the months ahead?
Optimism has seemingly returned into our survey respondents, which has been generally absent for recent years. While we could tie much of this shift to prospective and already initiated rate cuts, it will likely take more than one rate cut to make a noticeable difference in the marketplace sentiment that could lead to any real action. So we're particularly keen on any developments in prospective rate cut momentum that might jumpstart transaction activity. A top area that I mentioned earlier was the changes to tax policy. Will be tuned into the major results and commission appointments in the current year and in the new year. And the widespread adoption of AI could be the catalyst that the industry needs to revolutionize the real estate technology landscape. We'll be looking at tackling security, confidentiality head on with clients, which were two top concerns identified by the survey. Like leaders who plan for the changes could be the ones best positioned to capitalize.
Excellent. Sally-Ann, thanks so much for your time today.
Thank you, Sarah.
And to our listeners, if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.